Today with us, we have Jorge, which you've all already met throughout our past webinars. I'll hand it over straight to you, Jorge, to take us through the presentation today. I look forward to the update.
Thank you, Anne. Appreciate the time and good morning from Miami, Florida, in the U.S. To everyone out in the Sanlam private wealth community. Yeah, so it's a good time to catch up. We're winding down the year. We have less than 70 days, 75 days left in the year, and so I think these are timely calls because it allows us to mark time to see where we are, to review the markets, and more importantly, to provide some guidance on what we can expect. The last time we met, it was back in May, and at that time, the markets were digesting the impact of the tariffs that President Trump had just enacted. And we were looking at possible recessions. We were looking at many uncertainties. We didn't really know what the Federal Reserve central bank policy was going to be in terms of moving interest rates or decreasing interest rates. The markets at that time were also negative. So the Standard & Poor's 500, all of the equity indices around the world were negative. So we were sort of in uncertain times because of the impact on the tariffs and because of the potential impact on inflation. So now we have the benefit of hindsight, looking back 6 months and looking at what 5 or 6 months and looking back of what we've seen, what's the impact and what has been the result. So I think one of the things that we like to preface in these sessions is investing is the markets are the best source for wealth creation, but it comes with some uncertainties and some volatilities. And so the importance of sticking to the plan, staying invested. If your investment horizon is medium to long term, staying invested, because when markets do pull back, like we had back in May, always the first feeling that an investor wants to do is to de-risk portfolios or leave the market. And oftentimes, and it's almost always, that the markets recover and the investor misses out on that recovery. So the importance of not missing out on those snapbacks, on those recoveries is very important to not only creating wealth but maintaining wealth. So with that, I'll get started. So the agenda for today is I'm going to touch on the economy. Obviously, that's the first and most important thing. Then we'll talk about tariffs and the U.S. tariffs and the implication that we've had. We'll also look at the inflation picture, where we've come from for the last several years and where we are today and where we think we could be heading. And then that translates to interest rates. What is the central bank policies around the world, the Federal Reserve here in the United States, the Central Bank of England, the European Union Central Bank, and so forth. That's important. Then that goes into what is the business sentiment and what does productivity look like today, and what could we expect for the remainder of the year. But most important, we're providing guidance for 2026 and what we can have. And then these indicators we believe will make a bullish case for widening profit margins for corporations. And in turn, that translates to rising stock prices and wealth creation. And then we'll finish off with a performance review of the AI managed ETF portfolios that they've done well in this market environment. And then at the end, we'll leave it for some questions and answers sessions as well. So let me start with the economy. And just to put it into perspective, this chart or this table shows the 5 largest economies around the world, and by size of GDP, by the gross domestic product, how much they produce, how much they consume, and then the percentage share of that GDP in the world. And so we always start with the United States because it's the largest consumer, it's the largest producer, producing $30 trillion a year. or 26% of the global GDP output. So tariffs are very important because all of the other countries, all the other regions and countries below are trading with the United States as a trading partner. So that's vital for production and consumption around the world. And so going into this year and perhaps next year, we'll have much more clarity on tariffs. Just from last week, we had, President Trump had announced that he was going to enact, again, 100% tariffs on Chinese goods. And I think now, 6 months into it, I think we see that this is sort of a negotiating tactic to get concessions for the United States to get their products on the shelves on a global platform. And so we see that these initial tariff movements are announced, but they are not enacted. And so we see this as negotiation and again the impact. But we've seen some impact already. European Union. So if we look at the European Union, 27 countries, trading bloc, 20 trillion in GDP, or 16%, second largest aggregate economy. Then it's followed by China, 20 trillion, or 16%, Japan, India, and then we have the rest of the world, which includes Africa, Southeast Asia, Latin America, and other countries with 39 trillion, or 32% of output. So to put it into perspective, the United States leads in consumption, and so it's important to see what's happening in the United States and how that spills over for the rest of the world. So in terms of the economy and GDP, gross domestic product growth, the chart on the right, we can see that from August of 24, we had GDP expansion, and then we got hit with this massive inflation. Interest rates rose significantly here in the United States and around the world to control this inflation scare. Now we're on the other side of it, where the Federal Reserve here in the United States started lowering interest rates, and now expectations for this year and for next year, the gray line for next year, we see that the market is anticipating that we will have GDP growth higher than we anticipated earlier this year. That's very important. Sentiment has changed. So it doesn't look like there's going to be a recession here in the United States, which we were discussing on our last call. And we think that not only is it's not a soft landing, but we can have some GDP growth, and so that's important. Unemployment, labor rebalancing is very important. So the unemployment rate has risen very moderately, but it's still below the 20, 30-year historical trend, still below the 5%, well below the 5%. So even with the U.S. government shedding jobs and governments around the world are shedding jobs, we see that the private sector has also started to trim down, but it's on the margin. So we don't see huge labor disbalances. And so we believe that margins will maintain the same. And then the third bullet point is we're in the midst of a powerful generational productivity gain powered by artificial intelligence. I think all of us are using AI in some way or another, whether it's through our telephones, whether it's through our automobiles. Just as a side note, Tesla is testing now complete autonomous driverless vehicles in one city here in the United States, where they're going to have taxis pick you up, a Tesla taxi pick you up without a driver. It'll take you from point to A to point B. Tesla has now full self-driving vehicles or features in their automobiles, and so that they have that feature available now. And again, that's coming into the greater economy. So we see the impact of AI and the auto industry. We're going to see it, and obviously in technology industry, we see it in all industries. And so that's having a big impact on productivity, and productivity then that in turns into equity valuations. It's good for the market. It's good for all of us. So that's an important thing. And I think we're just getting started on this AI. Here at Prospero, we've been utilizing, interestingly enough, artificial intelligence to manage portfolios since 2017. So we're sort of one of the early adopters when it comes to AI and identifying trends and moving quickly on those trends, capturing those movements to preserve wealth and to create wealth. And I'll talk more about that in a few minutes. So that's the first piece on productivity or on GDP growth. We think that going into next year we're going to have higher growth than we've had this year, and this is a big change from earlier this year where we were discussing a potential slowdown or potential recession. Now, in terms of tariffs, they've turned from headwinds that we had in earlier this year to somewhat of tailwinds, right? Somewhat supportive for the market. So on July 4th of this year, Trump's big signature tax bill was enacted. It's labeled the One Big Beautiful Bill Act, which lowered corporate taxes. It lowered some taxes for the wealthy here, and that decrease in taxes was designed to be offset by tariffs, by tariff revenue. So we've already seen 6 months. We've seen that the impact on the September 15th filing by corporations, where taxes fell by $100 billion. So corporations paid $104 billion less in taxes. That was offset by an increase in $94 billion in tariff income. So we see that because of tariffs, the U.S. economy were able to lower taxes. That benefits corporations, and then therein lies benefits stock prices, and it benefits all of us because we are all equity owners. We all own a piece of these, through our AI portfolios, ETF portfolios. So that's a big positive catalyst. That's feeding into earnings. So earnings are positive, and so we see that the net effect has been positive. This is 6 months into it. We have to see what's the impact for the next 2 or 3 quarters. I would say by the next March or next June, then we'll see the full impact on this. But the trend so far is positive in terms of tariffs. So although it creates a lot of uncertainty and a lot of movements, the big picture is it looks like it could be supportive for the U.S. economy. And here in the U.S., they haven't employed these tariffs in over 90 years. We have to go back to the 1920s, 1930s when we had these types of tariffs, and they haven't been employed. And so far, the market has digested it well by the net return so far this year. Then if we look into, tariffs creates inflation because those tariffs have been passed on to the consumer. So the consumer is paying for some of those price increases. And so when we see the consumer price index, which is a measure of inflation, we see that obviously inflation has come down from when we had the pandemic, from the COVID year in 2020, and then that translated to huge inflation. And again, that was created predominantly by the U.S. government, where they injected so much capital into the market, obviously in a very difficult market environment where we had COVID, we had the pandemic. And that created the following year, this huge inflation. So inflation rose to 9%. We hadn't seen that type of inflation here since the late 1970s. And so the central banks proceeded to increase rates from almost 0% and they moved aggressively to 5% in a very, very short time to control inflation, right? To not let inflation get out of hand, which is very, very important. And so when we see that when they increased rates, that obviously affected the markets in 2022. We had a negative year, not only for equities, but also for bonds, for fixed income in 2022. So it's very particular or peculiar that both equities and bonds decreased in that year. So if we see the report card for the Federal Reserve, they increased interest rates to hold off inflation. It looks like, inflation then significantly decreased in 23 and 24. It remains above the 2%, and that's the Federal Reserve mandate to keep inflation at 2% or below. Inflation has been running a little higher. It's running at 3%, and the forecast for next year is to run at 3%. And again, this additional inflation is being caused by the tariffs, and so the Federal Reserve is managing this, and it's looking at productivity to say, well, if productivity does pick up, then having a little higher inflation, it could be manageable, right? It just doesn't they don't want it to increase again, and again we've seen that the tariff picture is balancing off. So market expectations for next year is, look, we may have this inflation around 3%, running a little harder than they desired, but even with that scenario, the Federal Reserve in September decreased rates here for the first time in a while, 25 basis points. It looks like they're going to decrease rates again this month and next month. So I'll lead more into it in a second. But inflation looks like it's mainly under control. And so in terms of interest rate policy, in the chart, looks like a busy chart with a whole bunch of lines, but basically these are the five main central banks around the world, the US, the European Union, United Kingdom, Canada, and Japan. And we're looking at interest rates, for the last 20 years, since 2006. So we see that rates rose significantly prior to the 2008-2009 crisis, the global financial crisis. They remained at very low rates for a very long time because caused by the great financial crisis. They rose again in 2017. We had some growth. And then 2020, we had the world come to a stop, the pandemic. That created inflation. And then all of the central banks in 2022, we can see that rose rates very, very rapidly. And again, we haven't seen this aggressive posture by the central banks in 30, 40 years. And so they were very aggressively raising rates to control inflation, which we saw on the previous slide. It looks like it's controlled. And now we're on the other side of it, where the European Union in blue has been decreasing rates much faster than here in the US. But the trend for all the central banks is that rates will decrease. And that's very positive for the markets, because that in turn translates to loans, car loans, mortgages, consumption. So the cost of money decreases. That's good for the economy. You have money velocity increasing, which in turn is good for corporate earnings, which in turn is good for our portfolios. The one exception is Japan, where they've started actually increasing rates very moderately, but they've been at zero for about 30 years. So they're trying to reinflate their economy. But the big picture is interest rates are coming down. The expectation is that they will continue to come down. Maybe they come down maybe another half a point to a point. And that's going to be very supportive, very positive for the global economy. So with the Federal Reserve easing, and then also we have fiscal from the government side, fiscal spending, that leads to sustained growth. So we believe that, again, finishing off this year, going into next year, we may have a very constructive market. Then that in turns to, if we have clarity in the economy, if we have inflation under control, if we now see that interest rates are coming down, then what is the global business sentiment and what is productivity, right? That translates to that. So that's the next piece of it. So productivity has risen this year, and we think it's going to continue into next year. Investment in AI, it's every time if you turn on the financial news, you will only hear about AI and all of the global companies that are leading this front for everything that we do, for education, for pharmaceuticals, for the auto industry, for transportation. We're having some significant gains in productivity, which in turn leads to higher valuations. So the chart, again, sort of a busy chart. This is looking back the last 10 years. The blue line is, we're looking at the European Union economic sentiment. So this is the sentiment of the sort of leading economies, leading companies in the European Union, what they believe business sentiment is. And then the green line is the Chinese industrial activity. And we can see going into from last year, 24 to 25, although it looks like a very small increase, but the trend is trending upwards in both lines. So the trends are positive. That leads to expansion. That leads to investment, and so that is an important thing. NATO, because of the obviously the war in Ukraine and Russia, they have committed to increase their federal spending in defense, and so we're seeing that the NATO alliance has become stronger because of this, and so that has some spillover effects into the general economy. So again, global business sentiment positive, increasing, and this is being led out by this big productivity gain in artificial intelligence. So in terms of, if we were to do a quick summary, we see that we have resilient growth, both from the consumer side, consumers spending, and from the production side, productivity expanding. So that leads to expansion. So we believe, again, GDP and the economic growth is going to continue, very positive. We see that policy tailwinds from a monetary side, from the fiscal side. We have the government here in the U.S. increase spending. We see the European Union also increasing spending, and so that's supportive for the market. We see that inflation is stable, and it's good enough for profit margins, so that's good for equities. We see that interest rates are coming down, expectations that interest rates coming down, so that again provides a favorable outcome for the economy. And the markets are pricing for rising growth. So with costs being stabilized for inflation, we think that earnings will expand, and so that's a positive. And then lastly, resilient consumer and the Fed is focused on supporting the labor market, adds to a solid backdrop to the economy. So overall, if we look at the overall picture compared to 6 months ago, it's very, very different. And that's why these calls are also timely, so we can sort of review where we are, what's happening in the world. This year, obviously, lots of news has been very active. And so far, if we look at the results, it's been very positive. Now, I just made the case for, obviously, the markets will increase, the economies will increase, and so forth. Now, if we take a big picture view, if we look back into the 1980s, right, we've had a whole bunch of corrections. We had, the invasion of Ukraine, COVID, when Brexit, when the United Kingdom exited the European Union. We have the great financial crisis. We have the 2002 dot-com bubble burst. We've had many, many, many pullbacks and corrections. And so this chart depicts the growth of $10,000 invested in the S&P 500 since 1980. So taking a very big, long view in the markets. And so again, the markets do not increase linearly. They increase with some pullbacks. We've had very strong markets since 2022. So 2022, was the markets were down pretty significantly. They recovered in 23. They've done very well in 2024. Again, current markets this year. So at some point, we may have a pullback, right? The markets don't increase this way. The most important thing is if you're a medium to long-term investor, the important thing is to stay invested. And when we do have a pullback, see it as an opportunity to buy the largest global companies, to buy them at a cheaper price, right? If you're investing for the medium to long term. So view any pullbacks as a buying opportunity if there's liquidity, or staying the course if you have that investment horizon. If your investment horizon is short term, then obviously any significant pullback where you may need capital is you have to look at that. But medium to long term and wealth creation is taking advantage. If an investor had taken advantage of on each of these pullbacks, the impact on this growth would have been a lot more higher. So that's the first thing. The second thing is volatility is part of the game, is part of investing. So if we look back since the 1950 and we look back at corrections greater than 5% per year since 1950, on average, there are 3 corrections, 3 pullbacks of 5%, right? If we look at on average, how many corrections have we had of 10%? On an average, we have 1 correction of 10%. Then if we say, okay, well, how many times has the market corrected more than, or up 15%, up to 15%? We had then that translates to, instead of once a year, once every 3 years, we have a pullback of 15%. And then if we say, well, what is the how many times the market has pulled up 20%, right? And that happens every 5 years. So again, these things happen, but if you see the long-term trend, the medium to long-term trend, the markets recover, and this is where the importance of maintaining hindsight. On average, here on the chart, 75% of the time the markets go up, right? So only 25% of the markets go down. So the trends is your friend, right? The longer you stay invested, likely is that this leads to wealth creation. Okay, then I'm going to switch now to, okay, what does that translates to our investment portfolios? How are the portfolios doing and so forth? So this is the results of the Prospero AI Balanced ETF portfolio, and we're looking at this as of September 30th. And September 30th, we see on a year-to-date basis, the portfolio is up almost 10.5%. On a one-year basis, so looking back from the last 12 months, roughly up 10.5%. If we sort of take the average annualized return for the last 3 years, over 16%, almost 17% performance over the past 3 years. Fantastic. Over the five years captures 2022, even with that big correction, we've averaged 7% on an average basis. And since 2017, since we launched these portfolios, 6%. So consistent performance across the board. Now, if we look at volatility, the other side of the coin, one side of the coin is return, the other side is volatility. Volatility is measured by a measurement called standard deviation, which means is how much deviation, how much variance do we have? And this measure of 8.74 equals that of almost of bonds. Like if you were to buy a bond, bonds have a volatility between 7 and 8, 6 and 7. Well, the measure here is 8. So we're getting equity returns with very little volatility, which is important. So the AI portfolios, as I mentioned in the past, and I'll try to wrap up because I'm going over my allotted time. But the AI portfolios have 2 main rules. One is avoid capital loss. Do not avoid capital loss. Do not participate in down markets. But if they do participate in down markets, is get back into the market as quickly as possible to capture the recovery. So that's rule number one. Rule number two is the AI solution is looking at the market only in 7-day intervals. It's looking to see what is the most probable outcome for the next 7 days. It's not looking for the next month, for the next quarter, for the next year. That's too long. It's looking up for what's most probable outcome for the next 7 days. And based on that, it's going to invest in a combination of bonds, fixed income, and equity indices to come up what's the best formulation, what's the best mix for that given week. So in turn, that turns to a very tactical solution where it adjusts to market conditions on a very rapidly basis. Every single week, it's resetting, it's recalibrating, it's repositioning to maintain rule number one, which is avoid capital loss. So we see by these results that it largely has delivered the objective of providing consistent returns with very low volatility. We also show, so in terms of how these are very tactical, so when we see each of the ETFs, these are indices, the things that get invested in. So what these AI portfolios are really, they give the investor broad exposure to invest in combination of U.S. equities, so the U.S. economy, global economy, emerging markets. So really have a very wide investment skill set to take advantage of not only stocks, equities, but bonds, short-term bonds, long-term bonds, emerging market, international. And so it gives us a very wide view. And these are very tactical, that they change on a weekly basis. So from one week to another, it will change. And just for example, if we look at the first week in September, the AI balanced portfolio went 52% in cash. So it was looking at possible pullback, and it decided to go into cash, right? Have low exposure to equities. And then the following week, we can see that it decreased the cash position from 52 to 2, and it increases bond allocation, right? Bonds are bonds are returning 4 or 5%, and so increase the bond allocation. So we can see from one week to another a very big change in that, and this is an example of how tactical these portfolios are, which is very different from normal portfolios that are sort of they don't move as much. So we have a very tactical, strategic portfolio. So when we look at the Prospero AI growth, the Prospero AI growth gives you exposure to equities. So when the equity markets do well, you will do better as well. And when we look at the return on a year-to-date basis, up 13.85, so almost 14%. On a one-year basis, the last 12 months, a little over 16%. If we look at the average return over the last 3 years, almost 24%. If we look at the average of the last 5 years, taking 2022 into account, almost 11%. And since inception, over 10%, 10.73. So again, delivering consistent returns. And so I was finishing off again. This is the AI growth. And so when we look at the allocation from one week to another, very similar to the balance at 32% in cash in the first week of September. Then it decreased that to 2%. And then it maintained a pretty firm equity exposure or balanced exposure to equities, to bonds, to gold. Gold is up almost 50%. So making sure that we participate in that rally as well. So overall, a positive picture. So again, big picture is we see a very constructive market in terms of earnings, interest rate policy, inflation, which can translate to continued strength. And again, I also want to caveat that at some points, if we do have a pullback, it's a normal part of the market. The main thing is to stay the course. With that,
thank you so much. Thank you so much, Jorge. Just a question from me. If you can just go back to that second last slide on the allocation. Yes, that one here. So, I see you've created on a weekly basis. So we can see that there has been some trades. So I can see here week 1, 2, 3, 4. So that's basically showing us that there is a trade being done every other week or every week.
Yeah, so it's it's good. So it's a busy table. It's lots of information, but so this trades once a week. So this is looking, what is the objective of the AI portfolios? Avoid capital loss. So number one, avoid capital loss. Number two, look at the market out 7 days, and it's evaluating, it's analyzing. AI. What is AI? It's using a lot of math on each of these individual indices to come up with what is the most probable outcome for the next 7 days, right? It's saying, well, and then based on that, it'll say, okay, let's give it exposure, right, for those next 7 days. And this resets every single week. Every single week is going to recalibrate. Okay, what is the most probable outcome from the first week to the second week of September to the third week of September? And based on that, it'll invest in the best instruments and the best indices it sees, it analyzes for that particular week, right? So we've had some changes in terms of, we see cash. Cash is important because cash is a volatility dampener, right? When we have heightened volatility or uncertainty, you want to go into cash. The most difficult thing, so de-risking portfolios, when I meet with investors and say, well, look, Jorge, I'm concerned with the markets. I want to get out of the market. And it's easy to go to cash, right? The most challenging aspect for the market is, when do you get back into the market, right? It's difficult to make that call on a short-term basis. What this artificial intelligence investment solution is doing is making that call. It's analyzing the market, and it's taking advantage of massive quantitative power to come up with that forecast. So just from the week of September 8th, where we had 32% in cash, to the following week, right, it decreased that cash position and then increased and went into the U.S. aggregate bond index. So that the U.S. aggregate bond index includes U.S. government bonds, U.S. corporate bonds. So, right, it's the widest bond index here in the United States, and so it increased that exposure. Bonds provide interest rate or coupons, and so it's picking up that. So from 1 week to another, a big cash allocation is maintained, a pretty steady exposure into gold, and that's been a positive aspect. And then I'll lastly say that with these portfolios, there are certain boundaries. So it can't not go into 100% in equities. The maximum that can go, the highest it can go is on the AI growth is 85. And the lowest exposure, the lowest you could have is 60%. So you can see that even with very good markets that we've had in September, right, it maintained the lowest equity exposure allowed, right? And that is based on what? Based on rule number one, avoid capital loss, right? So it's taking a defensive posture, defensive stance, and it's providing, the portfolios. This portfolio was up 4% in the month of September. So we can see how this, and so that's the first part. And then what I always focus in is on the last part, on the bottom part, the net equity. So just to give you the big picture. So the big picture is, for the first week, it had 7% in gold, 0 in bonds, and 32% in cash, and 60% in equities. And then the following week, we can see that increased bonds, decreased cash, and so forth. So you can see from 1 week to another what it is. When you see 60% is the minimum equity exposure, so it's being defensive. If we go back to the balance portfolio, the minimum equity exposure they could have is 40%. That's the lowest it can go. They can go as high as 65%. And so if we look at from 1 week to another, it always remained at the very low end of the range, 40%. And the last 2 weeks, they went to 45%. Again, capture an upside, but in a very managed way, looking at risk.
Thank you for that, Jorge. I think it's very important to point that out, because although the clients, even if you are invested in a growth portfolio, there is that mechanism in place that limits the not the losses, but the market fluctuation as well. So if it sees that it needs to go into a higher cash position, the portfolio will readjust on a weekly basis and adopt that cash position to try and minimize any fluctuation that we see in the market, which, like we have seen the past few months, has happened quite a lot. Jorge, with that last comment, I think we are already out of time, unfortunately. But thank you very much for the update and on the market and on the portfolios. Let's do another session before the end of the year to look at perhaps a yearly update for our members towards the maybe perhaps early December before everyone close off. Jorge, thank you very much for your time. Thank you for joining us. Thank you everyone who joined us online. If you have any questions, as always, you've got my details. Don't hesitate to reach out and we can go through any aspect that we've covered today. If you need anything specific, I can always reach out to Jorge and assist you there. Thank you, Jorge.
Thank you, Anne, so much. Thank you, everyone. Have a great afternoon, and we'll look forward to our next conversation.